financial reporting. In this mentoring session, we will guide you about the chapter of Ind AS, which has been newly included in the syllabus of Paper-1 financial reporting. Let us take few queries which have been received by us. Manoj Santani. Manoj, you are asking whether this topic on Ind AS, whether the theoretical question will be asked in the examination or practical problem. Manoj, this is a newly included chapter in the syllabus. Right now, we have issued a supplement based on Ind AS, wherein the summaries of all Ind AS, significant differences of Ind AS vis-a-vis existing accounting standards, and the carve-outs from IFRS have been covered in detail in the supplement. You are advised to focus on the summaries of all the Ind AS and the differences of these Ind AS vis-a-vis existing accounting standards. So, as I have already told, that this topic is recently included in the syllabus and this is applicable for the examination from May 16 examination for the first time. Therefore, the theoretical question based on the concepts of the Ind AS and the differences, as I have already told, will be asked, and no practical question is expected to be asked in the examination. The weightage will be around 8 to 10 marks from the Ind AS. This is a general expected level of weightage which is expected. It may be slightly more or less. So one should be very sure that no numerical problem based on the technicalities of the Ind AS will be asked in the examination. Jama, you are asking when shall Ind AS to be applied in the financial statements of non-corporate entities. Jama, to be very frank, this has been very clearly mentioned that all the Ind AS are applicable from 1st April 2015 voluntarily or mandatorily from 1st April 16 and 17 in a phased manner. I will tell you about the roadmap wherein the calculation of net worth, the guidelines for the respective applicability of the Ind AS has been clearly specified. And for non-corporate entities and SMCs, these Ind AS are not applicable. That means the existing accounting standards AS1 to AS29, which have already been notified under the Companies Act, they will remain applicable for all the non-corporate entities, and the non-corporate entities will not be required to follow Ind AS. They will not be under any obligation to follow Ind AS. They are exempt. Maybe after few years, it may be notified that these non-corporate entities are also required, but right now the situation is that they are not required to present their financial statements as per Ind AS. As I have told you the weightage, the type of the questions which are expected to be asked in the examination for this particular chapter of Ind AS, which has been included in the curriculum of financial reporting in place of earlier chapter 2, which was based on IFRS and US GAAPs and the differences therein from existing accounting standards. It means that the chapter on IFRS is no more applicable for the syllabus and you are not required to study the same. This is a general instruction for all the students, so listen to it very carefully. If you have January 15 edition of the study materials, then Ignore chapter 2 and chapter 6 study material. Chapter 2 was based on IFRS. That chapter was completely based on IFRS, which is no more applicable, which has now been redundant for the syllabus of financial reporting. And chapter 6 on financial instruments, which was based on AS 30, 31, 32. Now, as I have told, we have already taken the complete mentoring sessions on financial instruments, which were earlier conducted in the month of January by Board of Studies for the chapter of financial instruments. That as AS 30, 31, 32 were not notified, it was found that they are no more applicable for the accounting of financial instruments. Therefore, this chapter is also required to be studied in line with Ind AS, corresponding Ind AS, which deal with financial instruments. Therefore, if you have January 15 edition of the study material, ignore chapter 2 and chapter 6 and study the supplementary. There are two supplementaries which have been issued by Board of Studies. One supplementary is this. This is a supplement. Okay, there is some technical hitch which, due to which I am unable to show you the supplement, but there are two supplements which have already been hosted on the website also. One is based on Ind AS and one is based on financial instruments. So if you have January 15 edition, in place of chapter 2 and chapter 6 of the study material, you are advised to study the supplements. If you can get these supplements from the stores, as well as you can download these supplements from my BOS knowledge portal of the institute website. One more query has come in between. Archana Suryan, you are asking what type of the questions? I think you have joined recently, Archana. I have already told the type of the questions which can be asked, but still I am repeating it again for benefit of all of you. Archana, this chapter is new for all of the students who are appearing in May 16 examination. This chapter is, because this chapter is new, it has been decided that the questions will generally be asked either on the carve-outs of Ind AS vis-a-vis IFRS or the differences of Ind AS from IFRS. So definitely if that questions in the examination will be asked on this particular aspect of the chapter, then I think no numerical problem based on the technical aspects can be asked. The question will definitely be a theoretical problem, maybe of 5 or 6 marks. This is the general assumption which we can make. And regarding the chapter of financial instruments, many students are asking about financial instruments also, so that's why I'm clarifying again. However, we have taken the complete mentoring sessions of financial instruments in the previous month, and video lectures are also there, which will be hosted on the website very soon on our cloud campus. We have recorded lectures on the topic of financial instruments based on the Ind AS, which are in the process, and we will try to host them on cloud campus as soon as possible. Regarding chapter 6, financial instruments, again, AS 30, 31, 32 are no more applicable, and the questions, simple practical problems based on the Ind AS, will be asked in the examination, and the problems will be similar to the illustrations, to the questions, to the journal entries which have been asked in which have been given in the supplementary paper, as well as chapter 6, which has been included, which has been revised in line with Ind AS and incorporated in my January 16 edition. If you do not have the supplement, you can download chapter 2 and chapter 6 from FR study material, January 16 edition from BOS Knowledge Portal. So both ways you can collect the material and you can read it, you can go through it and try to solve the questions on financial instruments so that you can have the confidence of attempting those type of questions in the examination. Be assured that only the simple questions based on conceptual issues, not based on complex issues, not based on very much technical aspects of the Ind AS will be asked in the examination. That much you can be assured of. Kanika. Kanika, you are asking about the financial instrument session. Yeah, we have taken the session already, and it was very much informed to all of the students on our cloud campus. But still, if you have missed that session, we will try to make some video lectures, and we are already doing it, and we will try to host it as soon as possible. So be patient, and in the meantime, you are advised to study the supplement and chapter 6. The questions given in the supplement are more or less similar to the questions which are given in the January 16 edition of practice manual or chapter 6 of the study material of January 16 edition. So basically concentrate on the concepts of Ind AS, dealt with financial instruments accounting, recognition and disclosure aspects, and try to solve the simple practical problems similar to the questions which are given in my supplement. Be confident and be assured that only those type of questions, not very technical, not based on complex issues, will be asked in the examination, as it's a new chapter, it's a new topic, and it is asked, it is coming for the first time in May 16 examination. Divyanshu, you are asking whether we are required to know the difference of AS and Ind AS for financial instruments, but in the RTP the questions are asked on this topic. No, Divyanshu, it's not possible. Regarding financial instruments aspect, I have told that Ind AS are only applicable for May 16 examination. You might be referring some previous RTPs because in the current RTP the situation cannot be there. But if still you have found some issues or some concept which is given in line with this, you are please advised to mail at my ID, which I will be giving you at the end of the session, and I will clarify you regarding this. The difference as AS 30, 31 and 32 are no more applicable for my syllabus of Paper-1 financial reporting for May 16 examination onwards. Therefore, that's why the difference of Ind AS with corresponding AS, that is 30, 31, 32, is also removed from chapter 1. Therefore, you're not required to study the same. So basically, all the differences of all the corresponding Ind AS vis-a-vis AS 1 to AS 29, you are required to study. But the difference of Ind AS related with financial instruments corresponding to AS 30, 31, 32, you are not required to study. This you have to keep in your mind. Plus one more thing, in chapter 1 of the study material, we have units based on individual standards. So the units based on AS 30, 31, 32 are also redundant and have been removed from my study material and syllabus as well. So you're not required to study them also. I think now I have taken many of the students' queries. I have this mentoring session is specifically meant for covering few Ind AS and corresponding AS, so that I can try to tell you about the differences therein. There are 39 Ind AS, as we all are aware, and we are through various mentoring sessions on weekly basis, on bi-weekly basis. We are trying to cover all the significant differences of all my existing accounting standards vis-a-vis corresponding Ind AS for the benefit of students. So please try to be regular and listen all the sessions per week, because even if you miss one of the session, all these sessions are taken in continuity each and every week. If you miss one of the sessions, then definitely the next week will be the continuing session of the previous one. You will not be able to apprehend, you will not be able to understand that session, the future session, if you have not attended the previous one. So please make it a habit to attend all of the sessions on Ind AS which are conducted by Board of Studies for your benefit only. Sorry, ma'am, Divyanshu, you are again asking something. Sorry, ma'am, I meant the carve-in and carve-out between Ind AS and IFRS financial instruments. Okay. She is saying about not the difference, but the carve-out. Yeah, carve-out is very much in course, Divyanshu. The difference of AS 30 and 31, 32 vis-a-vis corresponding Ind AS, that is not in course, as I have already told. But carve-out is very much in course. What is carve-out? What is carve-in? We have already taken a complete session on this, but still in my PPT, actually I have made my PPT based on some other aspects, and you are asking the questions which we have already, the topics which we have already covered in the previous mentoring sessions. So it's very difficult to proceed for me. I want to proceed further, but you are asking the questions based on previous mentoring sessions. Let me take one or two more and then I will proceed to my PPT. Manoj. Manoj, you are asking, AS 30, 31, 32 are not applicable, but chapter 6 have some problem based on AS 30, 31, 32. Which chapter 6 you are asking? Whether January 15 edition, chapter 6 you are referring? In that, definitely the total chapter is based on AS 30, 31, 32. But in my revised edition, that is January 16, there should not be any problem. Maybe some aspects, maybe some fundamentals of AS 30, 31, 32 are similar to the concepts which are covered in Ind AS. So you may be feeling that they are familiar with each other, but as such the chapter is based on Ind AS only. The chapter is based on Ind AS 107, 109 only. The chapter is not based on AS 30, 31, 32. You please try to study the questions accordingly, and if you find still any clarification you require, you let me know. Manul, you are asking about chapter 6 revised beyond supplementary. Is it like that nothing practical problem will be asked? No, I have not told that no practical problem will be asked on chapter 6. I have told only about chapter 1. Chapter 2. Because I am saying that on chapter 2, that is Ind AS based chapter, you are advised to focus only on the summaries to understand the difference of Ind AS vis-a-vis corresponding IFRS. Corresponding existing accounting standards. So as the question will be asked in the examination based on the difference, based on the carve-out, it automatically means that no practical problem can be asked. So my conclusion was only about chapter 2, not about chapter 6. On chapter 6, financial instruments, you have to, you are expected to solve the problems based on financial instruments. How can you expect that only the theoretical problem will be asked? In chapter 2, theoretical problem is expected to be asked, but in chapter 6, all types of problems may come. The problems, but that I can assure you that the questions asked in the examination will be of the similar type which is given in my supplement. So you study the supplementary material, you try to solve the questions given in the supplement on your own. Do not read the questions, but try to understand them. Try to solve them on your own. That's it. Let's go to my PPT, wherein I will try to cover AS3 and corresponding Ind AS, AS4 and corresponding Ind AS, and the differences therein. So this is my online mentoring PPT. which I will explain. This is a disclaimer statement. Please make it note of it. Students are also advised to refer to all the e-lectures, as I have already told, available on the student LMS for Ind AS and other topics also of the financial reporting paper. We are trying to cover video lectures on all of the topics of my paper 1 financial reporting, and we will try to load them on this LMS as soon as possible for your benefit. They are freely accessible. You can see them whenever you want. You are just required to register with your student registration number and start learning immediately. So this is a very useful service for all of the students. Now come to the specific topic of Ind AS. You are required to have introduction of Ind AS, an overview of Ind AS, what exactly it is, why they have been issued, and the significant differences of these Ind AS vis-a-vis existing accounting standards. Carve-outs from IFRS. Now, each and every aspect of this Ind AS, I will try to explain at length to you. However, we have already taken a separate session, mentoring session on these Ind AS, wherein these overview of carve-outs from IFRS have already been explained. But after attending the queries of students, I have realized that many students have missed the sessions. In brief, I will try to revise the concepts which we have already discussed in our last sessions. As you all know, this is a new chapter which is included in our syllabus for the first time from May 16 examination. Now, what is Ind AS? The Government of India, in consultation with ICI, decided to converse with IFRS, not to adopt. That means we are not adopting IFRS, but we are only conversing with them. We are considering each and every para of IFRS and deciding whether it's apt for us, whether it's suitable for economic conditions prevailing in India or not. If we find that no, this particular para is not meant for us, we cannot apply it, this will not suit as per our economic environment, we can make a variation to that particular paragraph. We have taken the base for formulation of our Ind AS as IFRS only, but we are taking each and every IFRS, considering each and every para of that particular standard, make it suitable for our economic conditions, our business houses, and then try to formulate each and every Ind AS. So it's a very lengthy process. The whole exercise is being conducted by ASB, Accounting Standards Board of ICI. So many persons, so many business groups are also associated, through which we can take the comments. At first, we issue the exposure drafts, and then after receiving the comments of the public, we make a complete Ind AS. There are total 39 Ind AS which have been notified by MCA till now. You are required to study from examination perspective all the Ind AS summaries given in your supplementary study material which has been issued. So this is a very vast area, as there are 39 Ind AS which have been issued, which you are required to have knowledge of from examination perspective, what now you will do? It's high time now. You don't have that much time that you read. You start reading each and every Ind AS and prepare notes of it. Now the focus should be examination oriented. What will you do to score good in this particular area? I will advise. So basically now it's very clear that what is Ind AS. These are basically converged accounting standards. Converge with whom? Converge with what standards? Converge with IFRS. So we have not taken the IFRS as it is. We have made changes in IFRS and made them suitable for us. What are the differences of Ind AS vis-a-vis existing accounting standards? What is meant by existing accounting standards? The existing one, AS1 to AS29. I will also like to tell you that in these accounting standards also, the existing one which have been prevailing in India till now, we are trying, ASB of ICI is trying to make revisions in line with Ind AS. So after few years, we may expect that all the accounting standards, whether existing or Ind AS, they will be at same length, they will be at par. And at one point of time, we may have only one set of standards, that is Ind AS, applicable for all. At present, we have a parallel run for a few years. We have two set of accounting standards. One set will prevail for the exempted lot, which are not required mandatorily to follow Ind AS, to apply Ind AS, and one set for SMCs and for the non-corporate entities, which will still be applying the existing accounting standards. What is carve-out? Many persons have asked about carve-out. Carve-out is the difference in application of accounting principles from IFRS. If I have made some variation in some particular IFRS while adopting it to my Ind AS, that variation is carve-out. That difference is carve-out. What is important? It's applicable from May 16 examination, and regarding which we have already issued a supplementary study material well in time, which is available at all the stores, counters, as well as it's available on our site also. Now, what is expected from the students regarding Ind AS as well as regarding existing accounting standards? Regarding existing accounting standards, AS1 to AS29, you are required to study. And regarding Ind AS, you are not required to study in depth. No, not required to study in depth. What you are expected to do? Introduction of all Ind AS. You should have knowledge about introduction of all Ind AS, along with the comparative study of existing accounting standards vis-a-vis Ind AS, and carve-outs and carve-ins vis-a-vis IFRS. In place of what? You are not required to study chapter which was earlier there, overview of IFRS and US GAAP. What is carve-out? I have already told. What is carve-in? Carve-in in the Ind AS is only one. There is no major carve-ins. There is only one major, only one carve-in. Carve-in is basically add-on in our Ind AS, which is not there in IFRS, but we want to give some better explanation. We want to explain it further, enhance the explanation, and we give some additional paragraph. So that additional paragraph is carve-in, but carve-in does not result in a difference. It does not result in a difference from IFRS because it is a similar treatment. We are advising also the similar treatment which is given in IFRS, but we are explaining it in a better way. We are adding value, adding more explanation to it. But carve out is definitely difference, where we are making a variation. Some particular accounting formula is prescribed in the IFRS for inventory valuation. We are not adopting that formula. We are giving some other formula. So that is a variation. That's a carve out. What is Ind AS? IFRS converse standards. I already told. They are principle based set of standards. In each and every transaction, in each and every aspect of recording, you have to see the intention. You have to see the content. You have to see the crux, what we wanted, and then you have to record it. All of these Ind AS have been notified in the Companies Act 2013. Separate companies' Indian accounting standard rules have also been formulated to guide the application of these Ind AS to various entities. They are very separate, they are very distinct from the existing accounting standards. So there is no confusion. Many students are confused. What is Ind AS? What is existing accounting standards? What chapter we have to study what? Whether Ind AS are applicable. If Ind AS are applicable, then definitely we are not required to study AS. Many students ask this type of queries, but I think I have told very clearly that for chapter 2 and chapter 6, you have to study Ind AS only. And for other chapters, there are 10 chapters in IFRS study material. For all the other chapters, you have to study only the existing accounting standards, that is AS 1 to AS 29. AS 30, 31, 32 are redundant and they are no more applicable. In last mentoring session, one student specifically asked about IFRS foundation. Who prepares IFRS? Who formulates IFRS? What is IFRS foundation? In the last mentoring session, we had shortage of time. We had to close the session because some other session was also expected at the same time. Now, I'm trying to cover. So if that particular student is attending the session, you please listen. This PPT I have made specifically for you. IFRS foundation consists of two bodies, IASB and IFRIC. IASB means International Accounting Standards Board and IFRIC means International Financial Reporting Interpretations Committee. The IFRS Foundation is an independent, not-for-profit organization which is working in the public interest. However, International Accounting Standards Board, that is IASB, was established in 2001 and it is a new name for IASC. Earlier, International Accounting Standards Committee was constituted and it was reformed as IASB in the later years, that is in 2001. The role of IFRS Interpretation Committee, that is IFRIC, earlier it was called as SIC. Now it is International Financial Reporting Interpretations Committee. Earlier it was known as Standing Interpretations Committee. All the interpretations were earlier issued by SIC. Now they are being issued by IFRIC, and all the accounting all the IFRS, IAS, IFRS, which were earlier issued by IASC, International Accounting Standards Committee, are now being issued by IASB. So, what actually is IFRS? We again and again say we are not adopting IFRS, we are conversing with them. We say that worldwide IFRS stated financial statements are accepted. our account, if an Indian company goes overseas for getting money, then overseas listing is not possible if you have not restated your financial statement as per IFRS. For global acceptance of your standing, for global acceptance of your financial statements, IFRS is very essential. The statement is of financial statement as per IFRS is vital. Why? Because each and every country has its own set of standards. Everybody will prepare as per its own convenience. How investors of one country will make sure that these financial statements are per some global standards? So this was a context, this was a necessity due to which these global standards were required, which were issued earlier by IASC, which has now been reframed as IASB. In toto, in entirety, what is IFRS? It consists of 4 aspects. It consists of 4 things. One is IAS issued by IASC and adopted by IASB. All the IAS which were issued earlier by IASC, that is International Accounting Standards Committee, were adopted by IASB if they were perfectly found by IASB. All the IFRS which have been issued by IASB itself, and interpretations. After issuance of a particular accounting standard, the IASB may consider to form some interpretation based on some accounting treatment, on some para of the standard, maybe on public demand or maybe due to some other situations. Then there is a separate committee in International Financial Reporting Interpretations Committee, which issue the interpretations. And IFRS consists of in toto, all these 4 things when combined they form IFRS. This plus this plus this plus interpretations issued by SIC. This was the entire concept of IFRS. And now India has decided that we will make our standards in line with these IFRS so that our companies have a better standing in the overseas markets. The lesser the carve-outs are, the lesser the differences of IFRS vis-a-vis existing vis-a-vis Ind AS are, the better the standing of the financial standing of the Indian corporates in the overseas markets. I think now you are in a position to understand all this. Already told, in February 2015, 39 Ind AS have been notified by MCA. These Ind AS are applicable voluntarily from 1st April 2015 and mandatorily from 1st April 2016 and 1st April 2017 in a phased manner. I will tell you, for some companies, it's applicable for a threshold limit of net worth is there, which will decide whether you are mandatorily required to apply Ind AS from 1st April 16 or 1st April 17. So these threshold limit I will quickly take. By certain specified companies meeting the criteria as already been mentioned in the, it was clearly mentioned in the notification which was issued by MCA. However, if any company wants, not non-corporate, for any company want, it can voluntarily adopt Ind AS, but you have to be very clear that the first reporting period will be 31st March 2016. That means first financial statement as per Ind AS will be for the financial year April to March 16, April 15 to March 16. And you have to give comparatives for the periods ending on 31st March 2015. You are also required to remember that if a company is applying Ind AS, then it will have to apply Ind AS for both standalone financial statements as well as consolidated financial statements. You cannot say that I am applying for standalone but not consolidation. This you cannot say. Once you are applying, you have to apply it. And once you have started applying it, you have to apply it for each year afterwards. Ind AS shall be applied consistently. Option 2, adopt Ind AS is irrevocable. The option is not revocable. Once you have started applying Ind AS, you cannot, in any future year, you cannot say that now I will not apply. Once you have started apply, you have to continue applying them. By what, even if you have applied voluntarily, it was not applicable for you, not this year, not next year, but once you have applied, you have to apply it for all the future years. So when you decide to apply these Ind AS on a particular year to your company, if they are not mandatorily applying on you, you have to think twice. You make a judgment whether you have to apply that or not, because once you make a decision to apply them, you cannot revert back. You cannot go back. Okay. So, mandatory compliance. In a very quick time, I will try to go through this PPT. This is clearly given in the roadmap, which has been given by MCA. All the listed all the listed companies as well as all the unlisted companies having net worth of rupees 500 crore or more, they are mandatorily required from 1st April 2016 to apply the Ind AS. Comparatives they have to give for the previous year ending on 31st March 16, that is 15-16 year, they have to give the comparatives. These companies as well as their holding, subsidiary, joint venture, associate companies of all such listed and unlisted companies whose net worth is rupees 500 crore or more, they are mandatorily required to apply Ind AS, no option to them. Okay, they cannot say that we will not apply. They have to apply. From 1st April, this the earlier PPT was meant for the date from 1st April 2016. Now come to 1st April 2017. From 1st April 2017, all the listed companies having net worth of less than rupees 500 crore, even if you are all the listed companies, even if your net worth is less than rupees 500 crore, you are required to mandatorily comply with Ind AS. And what about unlisted companies? Unlisted companies having net worth of rupees 250 crore or more, but less than 500. So the threshold limit is increasing. After 1 year, the threshold limit is increasing. For the earlier year, that is from 1st April 2016, we had that all the listed and unlisted, if they had the net worth of rupees 500 crore or more. But now from 1st April 2017, even if any listed company, if has a net worth of less, even if it's less than 500 crore, it will be required to apply the Ind AS. And what about unlisted companies? If they are having the net worth of rupees 250 crore or more, but less than 500 crore, they are required to apply. Unlisted companies, if they do not have net worth of, if they have net worth of less than 250 crore, then they can be exempted. So the word net worth, the amount of net worth, and the computation of net worth is very important to apply this threshold limit. Definitely, all the holding, subsidiary, joint venture, if a particular company is mandatorily required to comply with Ind AS, then its holding, subsidiary, joint venture, associate companies will also be covered. To whom the exemption is granted? All the insurance companies, banking companies, non-banking companies, companies listed on SME. That means SMEs, small and medium companies. All these companies are not required, but a separate roadmap has been designed for banking, non-banking, finance and insurance companies. Maybe in later years, they will also not be exempt. And a press release has been issued by MCA where it has been clearly mentioned that very soon a roadmap is being laid out for these companies also. How we will calculate the net worth? Section 2 of Companies Act 2013 defines net worth as the aggregate of paid up share capital, all reserves created out of the profit, securities premium account, less all the accumulated losses, deferred expenditures, any expenditure which you decide to write it off to the later years, not necessarily in the immediate year, is a deferred expenditure. Miscellaneous expenditure, all the miscellaneous expenditure like discount and issue of shares, whatsoever it is, which you are not written off in a particular year, and you are treating it as an asset in your balance sheet, that will be deducted from the calculation of net worth. Now, this was it was the general revision of all the concepts which were discussed in the earlier mentoring session. What is Ind AS? What is IFRS? What was the requirement of issuing Ind AS? How they will be applicable? Whether it's applicable for all, for what sort of companies, what manner they will be applicable, how to calculate net worth, because the threshold limit of net worth was clearly mentioned in the roadmap. All these things were defined. Now come to the specific portion of the chapter, which is very important. 39 Ind AS and corresponding AS, the differences therein. Ind AS 1, presentation of financial instruments, financial statements, vis-a-vis notified AS 1, that is existing AS 1, disclosure of accounting policies, and Ind AS 2, inventories, vis-a-vis notified AS 2, valuation of inventories, was already covered in the session which was taken in the taken on 17th February. So if somebody has not attended that particular session, you are advised to go to the supplement. It's not very lengthy. There are hardly few pages. We deal with the differences in both these standards. Please go through these standards again, because if we will continue the practice of revising all the differences in all the subsequent sessions, then we will have to take so many sessions, and we will not be able to complete our all 39 Ind AS before May examination. So for the benefit of all, without wasting much time on these particular Ind AS, they are simple, they have been clearly explained. You are advised to go to the supplement, you are advised to go through the supplement for these two Ind AS. If you have any query, you can mail me. And today we are concentrating mainly on Ind AS 7, statement of cash flows, vis-a-vis notified AS 3 cash flow statements. So all of us are familiar with AS 3 cash flow statements, but Ind AS definitely new for all of us. It's new for you, for us also, and for the companies also. All the companies also are required to study these. Let us come to the difference point by point, and then we will explain the relevant para of the AS or Ind AS. Ind AS 7 says specifically about bank overdraft which are repayable on demand. Ind AS 7 specifically includes bank overdrafts which are repayable on demand as part of cash and cash equivalent. As you all are aware, there are some bank overdrafts appearing in the balance sheet of a company on a particular date, which are generally considered to be the part of cash and cash equivalent, and which are generally repayable as and when the repayable on demand means as and when the bank demands. you are required to pay them back. Our AS3, which you are all familiar with, does not specifically deal with the item bank overdraft. It specifically does not say anything about it. But Ind AS 7 specifically mentions that all the bank borrowings are considered to be financing activity. However, any bank overdraft, if repayable on demand, it will be considered as part of cash and cash equivalent. This is a special characteristic of such banking arrangement that bank balance often fluctuates from being positive to overdrawn balance. So, this is a difference between Ind AS and our existing AS. Come to the second point under this difference: treatment of cash payments in specific cases. As you all know that AS3 is dealing with cash flow statement and the corresponding Ind AS 7 deals with cash flow statements. Ind AS 7 specifically provides the treatment of cash payments to manufacture or acquire assets held for rental to others. If you have manufactured certain assets or purchased some assets, but the intention is to give these assets on rental to others, either, and these assets are held specifically for sale in the ordinary course of business, then in AS 7, if these two conditions are met, then Ind AS 7 provides that these cash payments, all these cash payments should be construed as a operating activity, not investing. However, in our AS3, we do not have any of these requirements. If we purchase any asset, we take it as investing activity. If we receive any rent, we take it as investing activity. So this is the major difference between existing AS and Ind AS, where in Ind AS, it is specifically given that all the cash payments which are made to acquire or manufacture assets held for trading, that is held for rental to others or for sale, they will be treated as operating activity. This is a clear-cut difference. We are treating them as investing. This is a major difference. If I have already told, the question in the examination will be asked on a particular AS vis-a-vis a particular Ind AS. So all the differences you must understand, and for understanding the differences, you must have gone through the summaries of Ind AS, because AS you are already familiar with. All of us have been reading the existing accounting standards from so long. So we are already familiar with them. Ind AS is something new to us. We have to understand them afresh from a new angle. To understand the difference, you have to study the summaries. Even if you do not understand, you do not want to read the summaries, do not want to read so long, concentrate on the differences as I am telling you, learn them. If a particular difference is not being understood by you, then you refer the summary of that particular Ind AS. Otherwise, you concentrate on the differences which I am telling. These all the differences are given in a very clear manner, in a very detailed manner in your supplement also. Now come to the two differences I have told. One is about bank overdraft and second is about these cash payment made for purchase of assets which are to be given for rent or for sale. Third difference: new examples of cash flows arising from financing activities. Ind AS 7 includes some new examples which are arising from financing activities. What are those? Cash payment to owners to acquire or redeem the entity shares, cash proceeds from mortgages, cash payments by the lessee for the reduction of the outstanding liability relating to a finance lease. This is not something variation. These are only the add-ons which are given in some examples more are added. So no need to go in detail about them. Come to the fourth difference. Adjustment of the profit or loss for the effects of undistributed profit of associates and non-controlling interest. What is associate? All of us are aware about as AS 23. What is the definition of associate? I'm not going to go into that definition. Non-controlling interest, all of us are aware. Controlling means you are having the interest which gives you the controlling right. But here we are talking about non-controlling. So Ind AS 7 requires adjustment of the profit or loss for the effects of undistributed profits of associates and non-controlling interest. This AS requires you to adjust for not only distributed profits but undistributed. This is something which is different from our existing AS3. You have to remember this. And while determining the net cash flow from operating activities using the indirect method. You know, there are two methods of determining the cash flow from operating activities. One is direct and the other one is indirect. So under indirect method, Ind AS 7 requires adjustment of the profit or loss for the effects of all the undistributed profits also of associates and non-controlling interest, which is not there in our AS3. So this is a major difference. Now up till now we have taken 4 differences of Ind AS 7 vis-a-vis notified AS3. Come to the 5th one. Cash flows associated with extraordinary item. In under AS3, whenever you prepare cash flow statement, all the extraordinary items in all the 3 heads, whether it's operating, whether it's investing, whether it's financing, we have to separately disclose the cash flows associated with extraordinary item. But under Ind AS, this concept of extraordinary item is not there. It has been clearly given that no such distinction between ordinary and extraordinary item and no such separate disclosure is required. Extraordinary item term is in itself does not exist in Ind AS terminology. So this comes out to be a difference. 6th difference. Disclosure of amount of cash and cash equivalent in specific situations. Ind AS 7 requires to disclose the amount of cash and cash equivalent and other assets and liabilities in the subsidiaries or other business over which the control is obtained or lost. It means the intention should be very clearly specified. If you have obtained control, then if you have control, first of all, it is to be seen whether the control exists there in the subsidiaries or the businesses or not of the company on whom we are applying Ind AS. If we find that yes, the control is existing, then you have to separately disclose these 2 things, cash and cash equivalent and other assets and liabilities. If no control is there, then you're not required to disclose. However, as per AS3, existing AS3 on cash flow statement, no such requirement is there. So the changing in ownership interest in subsidiaries and other business is very clearly identified, is very clearly disclosed in cash flow statement prepared as per Ind AS 7, but not under AS3. This is a seventh and difference. Disclosure of the amount of cash and cash equivalent in specific situations. Ind AS 7 requires to report the aggregate amount of the cash paid or received as consideration for obtaining or losing control of subsidiaries or other businesses in the statement of cash flows, or disposed of as a part of such transactions. As we have already told you that these type of disclosures, these type of separate requirement for the changes in ownership or control of interest in subsidiaries and other businesses is not there in existing notified AS3. So this is a difference. Cash flows arising from changes in ownership or interest in subsidiary. Again, the same point in continuation with that. Ind AS 7 requires to classify cash flows arising from change in ownership, interest in subsidiary that do not result in loss of control. It also requires to classify such type of cash flows which result in loss of control, or the transactions, the cash flows which do not result in loss of control. So, which do not result in loss of control is to be classified as cash flow from financing activity. However, as per AS3, we do not have such requirement. So earlier we covered disclosure of the amount of cash and cash equivalent in certain specific situations where the control was intended, where the control was lost. Either it was obtained or it was lost. To disclose the amount as part of such transaction itself, but where the control is do not result in loss of control, then we have to classify it as cash flow from financing activity. Investment in subsidiaries, associates and joint ventures. Ind AS 7 clearly mentions the use of equity method or cost method while accounting for investment in associate and joint venture or subsidiary. Equity method or cost method is clearly explained under, we have equity method used under AS 21. So we are familiar with these two methods. They are not new to us. Ind AS 7 also deals with the reporting of interest in an associate or joint venture using equity method. Equity method is simple. You have to calculate, you have to ascertain the value of our control. You have to ascertain the value of our control in the other entity in which you are exercising the control, you have obtained the control. However, existing ASC does not contain any such requirement about the control, changes in ownership, interest in subsidiaries and other business entities. So this was a major difference of Ind AS 7 vis-a-vis notified AS 3. At some places in some paragraphs, use of different terminology has been used. And cash flows of a foreign subsidiary have been translated in a different angle. Ind AS 7 uses the term functional currency instead of reporting currency. Ind AS 7 also deals with translation of cash flows of foreign subsidiary. You know that AS3 does not deal with any translations. It does not deal with any translation of cash flows of foreign subsidiary, but Ind AS 7 covers it. And how we know that we have in AS3 we use the term reporting currency. However, Ind AS 7 use the term functional currency. However, there is no major difference between both of them. This is the only difference in terminology. What about disclosures? As you have already seen that Ind AS 7 has some more guidelines. Ind AS 7 gives some elaborate disclosures. So Ind AS 7 requires more disclosures as compared to existing AS 3. Definitely Ind AS, they are principle based standards for each and every aspect of accounting. For each and every item, they have a separate mention under the disclosures, which is not covered in our existing accounting standards. So this way, we have completed the differences of Ind AS 7 vis-a-vis AS 3. This was all about cash flow statements under both set of accounting standards. Now come to Ind AS 8, accounting policies, changes in accounting estimates and errors vis-a-vis notified AS 5, net profit or loss for the period, prior period items and changes in accounting policies. What is the objective of existing AS 5? First of all, let us understand some of the basic provisions of existing AS 5 itself to make the comparison of AS 5 with Ind AS 8. Objective of existing AS 5 is to prescribe the classification and disclosure of certain items. As you can see from the name itself, I'm going to the previous slide to show the name. Net profit or loss for the period, prior period items. So this is a special type of item which is prior period, which deals with prior years, and changes in accounting policies. Accounting policies already we know as per AS 1, and if there is any change, how will we deal it? And from the name of Ind AS, you see accounting policies, changes in accounting estimates and errors. So here we are dealing with estimates and errors and their treatments in detail. But here our main focus is slightly different. So from name itself, we can see the different aspects. Now come to this. Objective of existing AS 5 is to prescribe the classification and disclosure of certain items. Certain items means prior period items. In the statement of profit and loss, why we are prescribing the treatment as per accounting standards? To ensure uniform preparation and presentation. Otherwise, some entities may be doing some other treatments, and some other entities may adopt some different treatments, which may not give us the benefit of comparability of financial statements of two entities. Now, what is the aim of Ind AS? Ind AS is to prescribe the criteria for selecting and changing accounting policies, how you can select, how you can change, what treatment will you follow if there is any change in accounting policy, how will you disclose. Elaborate disclosures are given under Ind AS which were not there in our existing accounting standards. In most of the Ind AS, in most of the differences, while comparing with Ind AS vis-a-vis existing accounting standards, you will see that detailed, more elaborate disclosures are required under that, and they are more detailed. Ind AS are more detailed. They are purely principle based. In each and every aspect, they will see the intention of the entity, and then they will decide about the nature of the item. But whereas in our existing accounting standards, that intention is not seen in each and every case. Changes in accounting estimates, we are not clearly describing about their treatments. And correction of errors, how will you do the correction of the errors which have been taken place in the years prior to this particular year. So I think the objective must be clear of both the accounting standards, Ind AS as well as AS 5. What about extraordinary items? As we know that Notified AS5 clearly says about the extraordinary item, but in AS, I have told you the extraordinary term is not there. They do not use the terminology of extraordinary items. Ind AS 1, presentation of financial statements specifically prohibits the presentation of any item of income or expense as extraordinary item. So the terminology in itself is vague for Ind AS, but we are using, so this is the main difference between both standards. Definition of accounting policies. Existing AS5 restricts the definition of accounting policies to certain specific accounting principles and the methods of applying those principles. Existing AS5 restricts the scope, restricts the definition, and hence the methods of applying the principles, the specific accounting principles, is also curtailed. We are not giving as many options, as many varieties of methods which are given under Ind AS. Ind AS 8 broadens the definition to include the bases, conventions, rules, practices, in addition to principles. We are only using the principles, but under Ind AS, we are considering the bases, conventions, rules, practices, all types of gaps in addition to principles applied by an entity in the preparation. You have to clearly mention about all of them. But however, our AS5 was only restricted to the principles. Changes in accounting policies. Ind AS does not allow change in accounting policy even if required by the statute. We cannot change it even if it is required by the statute. However, existing AS5 allows if any change is required by the statute. So Ind AS does not give you more flexibility. However, our accounting standard provides you the flexibility to this particular aspect regarding change in accounting policy. Fifth difference is accounting for changes in accounting policies. What will you do when you have to change a particular accounting policy? Ind AS 8 specifically states that an entity shall select and apply its accounting policies consistently for similar transactions, other events and conditions. It means for all the similar type of transactions, you have to apply similar accounting policies. And once you have started applying a particular accounting policy, you have to apply it consistently. You cannot apply a particular method, you cannot apply a particular treatment for any particular transaction in 1 year, and then after in subsequent years, you cannot change it. This is clearly mentioned under Ind AS 8. Unless an Ind AS specifically requires or permits categorization of items for which different policies may be appropriate. So unless and until Ind AS specifically requires categorization of items, we cannot apply a different method in the future years. Accounting for changes in accounting policies. Neither existing AS5 nor any other existing standard requires accounting policies to be consistent for similar transaction, other events and conditions. So this is also a major difference between Ind AS 8 vis-a-vis notified AS5. Notified means existing AS5. In between, I am maybe referring existing one. Exceptions, retrospective application of accounting of changes in accounting policies. Our AS5, which is existing, does not specify how change in accounting policy should be accounted for. We just say that you have to account for it, but how, the detailed guidance is missing. That is not there. However, Ind AS 8 requires that changes in accounting policies to be accounted for with retrospective effect. However, in our standard is clearly mentioned, you cannot do anything with retrospective effect. Only from future, only from prospective effect you can do. But Ind AS says that you can do it with retrospective effect subject to certain exceptions. Some exceptions are there where it is impracticable to determine the period specific effects or the cumulative effect of applying a new accounting policy. Cumulative effect, I think everybody knows. Cumulative means the complete effect, the total, the aggregate effect of the combined effect of applying that particular policy. However, existing AS 5 does not give any such guidance. Prior period items. Existing AS 5 defines prior period items as incomes or expenses which arise in the current period as a result of errors or omissions in the preparation of financial statements of one or more prior periods. This is as per our AS 5, which clearly says about this. But prior period, the definition of prior period, you should see clearly that as income or expenses which arise in the current period as a result of errors or omissions only. No frauds, only errors or omissions in the preparation of financial statements of one or more prior periods. Ind AS 8 uses the term errors and relate it to errors or omissions arising from a failure to use or misuse of reliable information. So it means Ind AS 8 specifically states that errors include frauds also. But we are not saying that errors include frauds. We are saying that errors include only errors which are unintentional errors, not intentional frauds. Reclassification of material prior period item in Ind AS 8 requires rectification of material prior period items with retrospective effect. This rectification is very important because in our existing AS 5, we only talks about correction, rectification with prospective effect. Prospective is from today, from future. I cannot do anything from retrospective effect. I cannot do anything from back years. But Ind AS 8 says that we can do it, we can do correction of these items, we can do correction of our errors from the previous years also, which is not there in our existing AS 5. So this is very important difference. This is very significant from the aspect of rectification of all the prior period items and to make correction thereof. Disclosure requirements given in Ind AS 8 are more detailed, as I have already told. In most of the cases, in most of the Ind AS, the requirements regarding disclosure of items are more detailed, more elaborate as compared to disclosure requirements given in our existing standards. I think we can take one more standard. We have actually we try to cover 2 standards. We will take one more standard only. Ind AS 10 events after the reporting period vis-a-vis notified AS 4 contingencies and events occurring after the balance sheet. As we have taken AS 5, let us take AS 4 also, and then we will the remaining portion we will cover in the next mentoring session. It's not very lengthy, only 4-5 differences are there. Let us take it and then we will close the session for today and we will take the queries if there is any, and I will give you some more examination oriented guidelines, more guidance from examination perspective specifically. So Ind AS 10 events after the reporting period vis-a-vis notified AS 4 contingencies and events occurring after the balance sheet date. You might be aware that most of the paras of AS 4 relating to contingencies have been withdrawn corresponding to issuance of AS 29. So our main focus is only on events occurring after the balance sheet date with respect to AS 4 and events after the balance sheet date after the reporting period with respect to Ind AS 10. Non-adjusting event, if material, it means material non-adjusting event. It's the first point of difference which I am trying to explain to you. In Ind AS 10, material non-adjusting events are required to be disclosed in the financial statements, whereas existing AS 4 requires the same to be disclosed in the report of the approving authority, that is in the report of the board of directors. You might be knowing that AS4 says that all the non-adjusting events for which you're not doing any adjustment in your financial statements, these are events occurring after the balance sheet date, and you're not doing any adjustment in your financial statements, then you have to make a disclosure of this in the report of the approving authorities, that in the report of the directors. But Ind AS 10 specifically requires all these material non-adjusting events to be disclosed in the financial statements itself. So this is a major difference. Come to the second part, proposed dividend. As per Ind AS 10, dividend proposed or declared after the reporting period cannot be recognized as a liability in the financial statement because it does not meet the criteria of a present obligation as per Ind AS 37. Ind AS 37 deals with the provisions aspect and it is corresponding to our AS 29. So basically, we are not required to study at this point of time. We are not covering Ind AS 37, but only the definition part, present obligation. It does not satisfy the criteria of present obligation as per Ind AS 37. So that's why its reference has been made here. So proposed dividend are not required to be adjusted in the financial statements as per Ind AS 10. Such dividend is only required to be disclosed in the notes. Whereas, as per existing AS4, the same is required to be recognized in the financial statement because of the requirement prescribed in former Schedule 6 of the Companies Act 1956. Here, I am saying Schedule 6 of the Companies Act 1956 because Schedule 3 does not contain any such requirement. Schedule 3, as we all know that now we have Schedule 3 to the Companies Act 2013, but Schedule 3 does not have any such requirement. So, it is proposed to make a revision in the existing AS4, but till now that revision is not notified. So as per existing AS4 provisions, the same is required to be adjusted. However, there is no such requirement under Schedule 3 of the Companies Act 2013. But this is the difference. At today's point of time, this is the difference because Ind AS 10 does not require adjustment of proposed dividend, does not require adjustment for proposed dividend, only disclosure. Only disclosed, not adjusted. But existing AS4, the same is required to be recognized. Recognized means you have to provide for it. That means the financial statements are adjusted. Accounting treatment disclosure in case of inappropriateness of fundamental accounting assumption of going concern. You know, this is the basic fundamental accounting assumption of going concern. As per the going concern assumption, we assume that the business is going to run for long. It's not going to be liquidated. And all the valuations, all the accountings are done as per this concern. However, Ind AS 10 requires a fundamental change in the basis of accounting if after the reporting date, it is determined that the fundamental accounting assumption of going concern is no longer appropriate. Ind AS 10 requires a fundamental change in the assumption. You have to change your basis of accounting. But existing AS4 requires assets and liabilities to be adjusted for events occurring after the balance sheet date that indicate that fundamental accounting assumption of going concern is not appropriate. So, this difference is also very important. What our AS says that if you are able to foresee, if you are able to see that the going concern assumption is not fitting in particular point of time, on a particular point of time, that means you are able to see that the business is going to be liquidated, then all the assets and liabilities are to be adjusted. The valuation is to be made as the fundamental accounting assumption of going concern is no more applicable, it's no more relevant. All the assets are to be considered, to be considered on a liquidation basis. And you have to prepare, you have to adjust your financial statements accordingly. But as per Ind AS, if you see that this assumption is not applicable right now, then you have to change, your basis of accounting and then proceed accordingly. But you cannot straight away say that now we will do it on the liquidation basis. We cannot adjust the financial statements accordingly as per our own convenience. Accounting treatment and disclosure in case of inappropriateness or fundamental of accounting assumption of going concern. As in continuation of that, Ind AS 10 says every entity will be required to disclose the fact that financial statements are not prepared on going concern basis together with the basis on which you are preparing. You can prepare the financial statements on some other basis if the going concern basis is not appropriate, but you have to disclose it very clearly and you have to state the reason also. But AS4 does not require any such disclosure. However, existing AS1 requires disclosure of the fact that in case going concern assumption is not followed, you have to make a note of it in your financial statements. In case of breach of material provision of a long-term loan arrangement, consequent to change made in AS1, it has been provided. This particular para in Ind AS 10 has been made due to the change made in Ind AS 1. That is a history, so therefore the reference of Ind AS has been incorporated here. It is clearly given that in the definition of events after the reporting period, in case of any breach of material provision of long-term arrangement on or before the end of the reporting period with the effect that the liability becomes payable on demand on the reporting date, if the lender, before the approval of the financial statements for issue, agrees to waive the breach, it shall be considered as an adjusting event. So you have to see on a case-to-case basis, and if the person, from whom we are under a contract or under a loan arrangement, if the lender, before our approval of financial statement, agrees to waive the breach liability, agrees to make the amount which we were supposed to pay earlier, then it shall be considered as a adjusting event and the financial statements will be adjusted. But in our AS4, no such requirement is there. Ind AS 10 includes an appendix covering distribution of non-cash assets to owners, which deal inter alia with when to recognize dividend payable to its owner. But in our AS4, there is no such appendix, there is no such details. So this is the difference. Now, let us take some of the mentoring queries if they are having. Some more queries have come. Let us take them. Divyanshu, you are asking how many differences we need to learn for each Ind AS vis-a-vis AS. Maybe in some of the standards there may be 5, 6 or more than that. But if the question is expected to be asked for 4, 5 marks, then definitely if at least 4 or 5 differences you must be thorough with, and you must be able to write in the examination if the question is asked. When Winnie, you are asking about the schedule, I think the schedule of most of the future lectures have already been hosted on the cloud campus, but still I will see and I will try to give the schedule as early as possible so that you can make the convenience of your timings. Can you please explain fundamental change in basis of accounting in Ind AS? Actually, if that was regarding going concern, which I was telling, if the going concern assumption we are able to judge that the business is not able to manage, then as per our existing accounting standards, we make the preparation of financial statements on the basis that the business is not going to survive. And we value the assets and liabilities accordingly. But in case of Ind AS, we can change the method, we can change the base, and we have to give the clear note of it. And then we can prepare the financial statements accordingly. Shameen, you are asking about the weightage. I have already told you that the general weightage which is expected from the chapter 2 will be around 4 to 6 marks. There will be a theoretical question based on the differences or the carve-outs, differences of existing accounting standards vis-a-vis Ind AS and the carve-outs of Ind AS from IFRS. So these are the major aspects which you are required to focus. But if you are not able to understand the difference, I am advising this to read the summaries of Ind AS only to understand the difference part clearly. Because without reading the summaries, if you just go to rectify the differences given in the supplement, you will not be able to learn them. That was the only intention. Akshay, you are asking, is there any change in the existing accounting standards? No, there is no change in the existing accounting standards. There are revisions which are under process, and ASB is considering those revisions in existing accounting standards to make them at par with Ind AS. But till now, they have not been notified. The revisions have not been notified. Either they are just in the stage of exposure draft. So you're not required to bother. The existing accounting standards which are given in accounting pronouncement, they are only applicable for you. Kanika, you are asking about the asset which was given on rent, which was, Kanika, I was explaining the aspect of treating the rentals and the payments which the entity is making to purchase the assets which are supposed to be given on rent from the Ind AS perspective. And the angle was preparation of cash flow statement. So don't get confused and read the Ind AS in the supplementary corresponding to AS3. Then you will be able to understand the thing of operating activity which I was explaining to you. Aditya said, you are asking about limited exception. I am not able to understand the query. I am not able to understand what limited exception you are asking. Either you want me to explain the exceptions to the entities who are not required to Ind AS, or what kind of exception? You please elaborate. I am not able to understand the query. Whether we have to prepare consolidated CFS as per Ind AS 7. Akshay, the chapter of consolidated financial statements is to be prepared only as per AS 21. I have told only for chapter 2 and chapter 6. You are required to study Ind AS. For all the other chapters, you are required to study the existing accounting standards. I don't know why you people are getting so much confused between the other chapters also. All the other chapters are to be studied as per the existing accounting standards only. No need to confuse with the Ind AS. Only chapter 2 and chapter 6, which is based on financial instruments, that is to be studied. And in chapter 2, generally the theoretical type of question is expected, which will be based on the conceptual issues only, because this is a new chapter. And from chapter 6, definitely some small practical problem, simple practical problem can be asked, which will be similar to the supplementary which have been issued by us. Okay, thank you.